options are my bread and butter. They are very fun and exciting. They're basically a contract that is 100 shares of the underlying stock, and the third dimension that a normal stock investor may not be used to dealing with is that they have an expiration date attached to them. And these expiration dates can be very short. So you may be waiting for something to expire or watching something erode as the expiration date approaches. And you can also go long term with your expiration dates, but it will cost you. They'll be very expensive. And there's all kinds of different elements that having an expiration date tied to a stock price can really present. And the name of the game is to really get yourself into a position of a win-win. So you want to have one option if this happens and one option if it doesn't, and you want both of those to be profitable for you. And it's very, I don't want to say it's easy to do that, but in the way you're really crafting your strategies, that's kind of what the name of the game is. That's what you're building, and that's what you're trying to paint. And when you get it going, it's very exciting, and you just can keep repeating it and repeating it as long as things are going your way. Keep doing it, and it can get quite rewarding when you got it right. All right, here we are on Google Finance. I'm going to type in ticker symbol for HP. Over here you see the link to the option chain. Here are all the option prices. It defaults to the nearest expiration. HP apparently has a weekly option. The options are traditionally monthly, most commonly monthly, and that month is the third Friday of the month. That would be March 20th. Over here is a ticker showing the current price. Today's February 25th. So the weekly option is a little too soon. It's a little too short for my examples. So if we scroll down here, or if we see here the price is $34.67, and these are the strikes. So $34.67 would fall in between $34.50 and $35, and you can see the faint yellow for in the money options and the white for out of the money options. So this is the money line. This is the bid and the ask price. So if you were going to buy the the out of the money call option, you would spend $61. There's 100 shares, so this is the per share price. So just multiply that by 100. So it's $61. It would get you the $35 call option. It would expire on March 20th. If the price never changed, it would expire worthless on March 20th. So this is a stock chart showing the underlying stock. So if this was HP, right here would be the current market price. Profit loss would be 0. If the price goes up, you would earn more profit. If the price goes down, you would lose. So if you did buy that $60 call option, it would be approximately down here. So you would pay that premium, and here's where you would be sitting at negative $60, the premium. You'd be out that no matter what. If the stock goes up in price, you are exposed to 100% of the upside, and it's unlimited upside. And if the price goes down, you're limited to your downside risk. So it's actually appears to be a better deal than actually owning the stock. But remember, there's a time value connected to it, so it could expire worthless. You would be out, in which case you would be out the $60. Whereas if you had the underlying position, you would just continue to own the shares, and you could potentially ride them back up to a different value. The market could rebound. The other thing you can do That's if you bought if you were long on the call. You could also sell the call. So you can buy and sell. So if you buy, you pay the premium. If you sell, you collect the premium. So no matter what happens, you get to keep the $57 in this case. So if we sold the $35 covered call, it's called a covered call. So let's say you owned the shares. Let's say you bought 100 shares of Hewlett Packard a year ago and it was $20. So you're already up $1,000 because it's gone up over $30. So you're very comfortable. You're comfortable to sell at any time, and you decide, why sell? I'll just sell a covered call against the shares I already own. So the current price is $34.67. So you could sell the $35, or you could sell any of them if you want. You could sell the $37 one for $10. Keep the $10 and let it expire. If it doesn't expire, if the price goes up to 40 and you have to give up the shares, you still realize the gain that you made. So in this case, you would, which one do we decide to do? For example, we'll sell the $35 one for $60. So we keep the $60 no matter what happens. If the price goes up, we lose the shares. We give up our shares. If the price goes down, the option expires, and we keep the premium either way. If you scroll down from the calls or the puts, now everything's inverted, because the puts are the option to sell. The calls were the option to buy. So now that we're in the business of selling, the lower the price goes, the more it benefits us. So these lower numbers are out of the money, and these, out of the money, and these higher numbers are in the money. So if we bought the out of the money put right here, $81, we are out the $81. If the price goes up, we are limited with our downside risk. If the price goes down, we are fully exposed to unlimited potential. For as low as it goes, we'll keep earning more profit. Just like if we had shorted the shares with the underlying stock. If we sell the put, if we short the put, we collect the $76 no matter what happens. Maybe we are optimistic on the stock, but we're not sure about the timing. So if the stock price goes up, if we short the put, we collect the premium. And if the stock price goes up, we just keep the premium and nothing happens. If the stock price goes down, we're obligated to buy the shares at the strike price. So in this case, we would take the $76, and then if the stock goes down to 30, we have to buy the shares at $34.50 each. So we'd be owning these shares that we overpaid for. So our hope would be that if that did happen, our hope would be that the stock would rebound in value. And then that's it. It's pretty much puts and calls, and you can buy them and sell them. And then the premium, if you go back to here, this is the bid and the ask. So that's the premium. If you're buying or selling it, there's a little bit of a spread there. And that's it. That's as simple as it gets. Now it gets far more complicated when you start adding spreads, which is combinations of the two. So the most popular one would be the bull call spread, in which case, if you do that, we're going to change ticker symbols. Instead of HP, which is in the $30 range, we're going to go to Amazon. Share of Amazon is $385.37. So now if we go look at the out of the money call, instead of it being $50, oh wait, I go to March 20th, the traditional month option. Instead of it being $50, it's $840 to buy the call. So we're gonna do that. We're gonna buy a call option on Amazon. For $815. So we bought that, so we paid that premium, and now you sell a call on the same expiration date, on the same underlying share. In this case, we will sell the 400 for $370. So you pay the ask price, and when you sell a premium, you collect the bid price. So $370. At 400. So this is our new position. By selling the premium for here, we actually have helped our break-even point by $400. So we're moving this up now. So now if the price goes down to here, we spent $800 to get this call, but we collected $360 by selling this call. So our total loss will be in the $400 range. And if the stock price moves up, we would collect the profit just as if we had held that many shares without having spent that much money as the call would cost. Unfortunately, though, unlike just having a long call with an unlimited upside, this has a cap. When it gets to 400, where we sold the covered call, we would then be forced to sell the share. So we would not earn anything more than this line. So if the stock price goes up to here, we still stay where we stopped earning at 400. But that's still this much profit, which is what the investors who would make this play, that's what they were shooting for. Their target is to make this much profit. They're not interested in the cap. They wanted to make sure that their break-even point was attainable and that their total loss would be more comfortable than if it was twice this down here at $800. There's plenty of places to get more information. I can't really walk through all the different conditions that could happen on different plays. That's not my business. That's a lot of work too, and it could just be more confusing for you. I just wanted to lay a base coat out there before we begin going through some of these strategies.